Good evening, everyone, and welcome to the 6 key decisions every investor needs to make. My name is Jim Cruzan, and I'm talking to you this evening from Fenton, Michigan. The stock market today hit another new high for the Dow, and the S&P is just fractionally off of its high. Another way of looking at that is it's been, in essence, 6 years of 0% return, and we're just now getting back to where we were. The fact of the matter is, adjusted for inflation, the market would have to go up another 1,500 points or so to just get back to where it was 6 years ago, inflation adjusted. Today's topic, 6 key decisions, I think is timely as markets are near all-time highs. We're feeling a little bit better about the market. Maybe it's a good idea to take a moment and reassess why we're investing, what the purpose is, and how much risk we're really willing to accept. The program will be a fairly short agenda. There are just a few bullet points. First, intro, who we are, just to give you a little bit of an idea about our background and the kind of business we do. Setting the stage, why this discussion may make sense now, not only in light of the market and what's happened, but also what's happening from a corporate perspective. And then the 6 key decisions of a quick wrap-up, and then certainly we'll open to any questions anybody might have. Intro, who, what, and why. Our firm, Kaydan Wealth Management, is an independent advisory firm. We clear our transactions through Raymond James. We're not employees of Raymond James. We're predominantly a fee-based practice. Most of our revenue is generated through an advisory arrangement with our clients on a fee basis. For the most part, we provide retirement wealth solutions for employees of the extended automotive industry. Most of our clients are automotive engineers as well as executives. We're not limited to the auto space, but the vast majority of our clientele is. And part of the reason, I suspect, is we're here in Michigan, which is also ground zero for the auto industry. Our practice focuses on several comprehensive planning areas. Retirement planning, certainly. Tax planning, not preparation, but what can be done to effectively reduce or modify the tax effect. Investment planning, which would include things such as planning for additional purchases, gifting, education planning, estate planning and estate tax reduction, and risk management. We're very client-centric. It all starts with your goals and objectives, a detailed discussion about risk, your ability to assume risk emotionally. That would be tolerance, as well as your ability to assume risk from a capacity point of view. We talk about what aspects of the planning process can be controlled and what can't, and then we monitor every step of the way and make adjustments as needed. We have 2 locations, one in Genesee County, just south of Flint, Michigan, in Fenton, and one in Clarkston, which is in Oakland County. Our website, KaydanWealthManagement.com, will certainly provide you additional information about who we are, the type of business we do, and the type of clientele we generally work with. Let's set the stage. Why does it make sense to talk about these key decisions every investor needs to make? Well, certainly planning and executing a successful retirement isn't easy. And in fact, one could argue it's a lot more difficult today than it was 30 years ago. From a risk management point of view, and there are a number of aspects of risk we'll talk about in a moment, longevity has got to be one of the front and center ones. People are living longer, and as a result, add to that the fact that people are retiring sooner. You have 25, 30-year retirements potentially. In fact, 1 out of 6 boomers are expected to live into their 90s. We certainly know about the market and the volatility we've had there. And I made mention of the fact that currently the market is, this is the S&P, is just underneath where it was previously, was 1565. And you'll see it took about a 5-year period to get to that level. Over here, it took almost 7 years to get back to the previous level in 2000. Effectively, we've earned very, very little by riding this feast and famine roller coaster. And that's one of the problems with building a portfolio where the objective is just to beat the market, live by the sword, die by the sword. And it's really interesting because one of our biggest problems is our own emotions and how we react to investing. When the S&P 500 was at its low, 666 was the index. People felt despondency, there was little hope, there was depression. Many people just simply threw the towel in And then lately, the last couple of months, certainly the last month or so, since the first of the year, there's been a significant amount of euphoria. The fact that people are feeling better about the markets. They're more willing to put money in. Now, what does that say for a system, a process, where people are getting out near the bottom and are feeling much better about getting in after a 150% move off of the lows in 2009? Very, very dangerous. In fact, many affluent investors are still very risk averse and not confident at all about reaching their financial goals in spite of a significant rise in equity markets. This has a lot to do with the fact that we've given back most of the return several times now this past decade. In addition to market risk, we're seeing changing times with respect to our employer and work status. One area I know fairly well, we'll call it the mobility industry, because we deal with auto folks and heavy equipment folks and airline engineers, etc. We're certainly seeing a major changing landscape. Used to be, being an engineer, highly employable, was an entry level to upper middle class, along with a decent salary, was a very rich benefit package. Then along comes globalization, global outsourcing. Many of the domestic automakers that are now global are building huge engineering facilities overseas, Asia, etc. Very disruptive consolidation. And those golden handcuffs no longer exist. They're all free agents. And as a result, the bulk of their retirement success will be based on what they do themselves, not what benefits are available through the employer. In the state of Michigan, the state periodically does a research report conducted through Ernst & Young, and the readiness of a typical Michigan retiree. And I find this kind of interesting, and what I'm focusing on is this 22% right here, or minus 22%. The title of this is Reduction in Michigan Retirees' Standard of Living Necessary to Avoid Outliving Financial Assets. That negative 22% represents the reduction in current standard of living that every retiree would need to make now in order to make sure they're not outliving their financial assets. The average retiree these days is ill-prepared. As a result, changing landscape requires timely decisions and thoughtful advice. My hope is that these 6 key decisions can help provide a basis, a process to analyze what you're doing and how you're doing it and determine whether it's appropriate for your own personal goals and objectives. Those 6 key decisions are, what do you want to accomplish? Or another way of saying that, what number do we need to achieve? What level of risk are we comfortable with and we require to achieve those goals? If we're investing money at all, are we investing it actively or passively? Do we rebalance, and have we made a concerted effort to rebalance regularly? And if we do, how do we go about doing that? Do we benchmark our success and performance to something? And if we benchmark, to what? And last but not least, do you do it yourself, or do you look to hire somebody to do it for you? Decision number 1, the number. What do you hope to accomplish? We're very much client and goal-based, so to a large degree, a lot of our clients' goals have to do with personal financial security. I want to retire on a particular amount and over a period of time. In some cases, the goals are a bit more altruistic. I would love the ability to be able to help my children fund our grandchildren's education. And in some cases, it's charitably inclined. I'd like to make a gift to this endowment or to this charity, etc. In many cases, clients have multiple goals requiring multiple numbers, multiple values that need to be accomplished over multiple time frames. Finding the number is very important. That number decision is going to be based on a number of things. When do you want to retire? On what amount of income? On what amount of money? And what return is needed to achieve that? In many cases, those goals then need to be vetted out to determine whether they're needs versus wants versus wishes. and a certain priority and probability is weighted on those particular goals. A cash flow analysis needs to be done to determine what cash flows will come in, what do we need, and what gaps need to be filled, and what return do we need from our investments to fill that gap. In other words, what's the minimum required rate of return that we need to achieve those goals and objectives. That gives us an idea from a risk assessment as to what the portfolio needs to look like. What kind of risk is inherent in the portfolio that we would need to provide the rate of return that we seek to achieve those goals. And with that, it gives us a pretty good idea in terms of probability of success. The number is very important. You wouldn't design a machine without first knowing what you want it to do. You certainly wouldn't take a trip without knowing where you want to arrive at. Second key decision is how much risk. There are a number of risks facing retirees: market risk, company risk, political risk being several. Longevity and inflation risk are probably two of the most dangerous risks we face. 50% likelihood that one individual of a couple will live to age 84. 10% likelihood that somebody will live to 100. Very long period of time. And inflation takes its toll over that period of time. Inflation right now is pretty benign. Core inflation 1.9. However, the 50-year average is over 4.1%. Now, 4.1% over an extended period of time has a huge impact on costs of goods and services. From 1980 until 2011, a 31-year period, the average automobile went from 6,200 to over 30,000. The average house nearly tripled. The average loaf of bread tripled as well. A 30-year retirement is not out of the question. We know about market risk: a 49% drop with the dot-com bubble burst, a 57% drop during the credit crisis. These have dramatic impacts on our ability to achieve our goal. A greater risk, perhaps, is what happens at some point when interest rates rise. Here's a chart of interest rates going back to 1958. See the march up the mountain to the peak in September of 1981, when the 10-year U.S. Treasury bond yielded 15.8%. We've also seen nearly a 32-year drop in interest rates, culminating with where they are today. Today, they're just a hair over 2%. At the end of the year, they were at 1.76. The expectation, interest rates are not going to fall anymore. At 1.6, 1.7, there's very little wiggle room for them to drop. And that's important because at the bottom of this chart, you'll see the price impact of a 1% rise or fall in interest rates. On a 10-year bond, a 1% rise in interest rates produces a 9% drop in bond prices, and a 1% fall in interest rates relates to about a 9.1% increase. And you can see the longer term you go out, 30-year bonds, the fall is much more dramatic. At some point, interest rates are going to create risk in the portfolio. They will do less to improve return than they have in the past. Benjamin Graham of Columbia University said it best: the essence of investment management is the management of risk and not the management of return. It starts with risk management. And the reason is it's humbling arithmetic. A 50% loss requires a 100% increase just to break even. While CNBC is high-fiving the fact that the market is at new highs, the reality of it is people are now back to where they were 6 years ago. One way to combat the effect of risk is asset allocation and portfolio construction. In fact, the vast majority of the variable of performance is driven by asset allocation. It's far more important to have exposure in one category or another than exposure in one particular stock within the category versus another stock in the category. Getting the sector, getting the broad base right really helps quite a bit. This is a typical efficient frontier where we start with 100% bonds, and it has a certain risk and return profile. As we add stocks to the portfolio, in the case of 20% stock, return goes up, risk goes down. But then as we add 20, 40, 60, 80% stock to the equation, the prospects for return improves, but risk also improves. It's important to identify where we need to be on this to achieve the return that you need to meet your goals and objectives and carry the amount of risk that you're comfortable with. All of this is in an effort for you to stay balanced, stay diversified, and stay invested. Within the last 10 or 12 years, there's been other studies that have been done. One with David Svensson, who manages the Yale University Endowment. Craig Israelson at Brigham Young has also done some studies as well. And it's building lower volatility portfolios. The idea is to build portfolios that look different than a traditional 60-40 or a traditional stock versus bond portfolio. If we consider this as a typical old school balanced portfolio with some component of stocks and some component of bonds, the new school would suggest less direct stock exposure and more exposure to other types of equities that generally don't have the same return and risk characteristic as stock equity. An example of that would be something like this, which is built around 12 different asset categories. Those 12 asset categories represent U.S. market, large, mid, small, non-U.S., developed and emerging, real estate, commodities, natural resources, and several different bonds. This balanced portfolio has 41% stock exposure and about 66 or so percent equity exposure. It's different than a traditional 60-40 stock bond portfolio in that it has less direct stock exposure. In our practice, we manage a number of different portfolios. We have 13 different strategies. The purple strategies are traditional, efficient frontier, 20, 80, 60, 40, along the curve that we spoke of. The green strategies represent these multi-asset, globally diversified portfolios. And our multi-asset, globally diversified portfolio uses other categories than just U.S. stocks and bonds. Reason? In any given year, there are a number of categories that tend to perform better than just the S&P 500. This Callan chart shows performance over the last decade, and it's broken up in terms of different investment categories. The green box represents the S&P 500. In 2012, as an example, you'll see while the S&P was up 16%, small cap was up 16.3, Europe was up nearly 18, emerging markets was up nearly 19, real estate was up nearly 20. In 2005, when the S&P was up 5, emerging markets were up 14, commodities were up 21. It's not just stock classes that have this effect. If we build a portfolio around the U.S. Barclays Aggregate Index, which is the orange box, you will also see there are many different varieties of fixed income investment that have had a tendency to perform better. So the greater the diversity, the better the performance, generally. This shows the performance of the multi-asset, globally diversified balanced strategy compared to a traditional 60-40 balanced portfolio compared to the S&P. Notice over the 10-year period, a 10% compounded return versus a 7 versus nearly a 7. While this did show 3 down years, it tended to manage the downside significantly better than the S&P 500. So as a result, it didn't dig itself out of a big hole. Yet, when the markets recovered, the fact that it owns equity, not just stock variety equity, the recovering returns were every bit as strong as the stock market recovery. So if we lose less or have the potential to lose less in a bad year and have the potential to recover greater, generally it creates better long-term return. And as a result, while the S&P green bar averaged 1.7% since 1999 through the end of 2012, that's compound annual growth rate compared to 4% per annum for a traditional 60-40 balanced portfolio. This multi-asset portfolio that we spoke of averaged nearly 8% per year. Now, going backward and looking at what the indices would have done in building a very similar portfolio during particular periods of time. In this case, high inflation. You can see high inflation periods impacting the markets somewhat. Reason was this was during the Nixon resignation. The equally weighted portfolio would have been up 1 and down 5, not down collectively 40. During the dot-com bubble, instead of being down the 40-some% over the 3 years, the equally weighted portfolio would have been up 10, down 5, and down 1. This equally weighted portfolio would be equally weighted based on the 7 classes of assets that we have in front of us. And then the credit crisis, you can see where the market would have been up somewhat in 2007, down 37 in 2008 versus up 5 and down 27, 10% betterment. We've built a number of these global multi-asset portfolios to the point where it's very easy to have a sincere conversation with a client about risk. 2008, this would have been down 24%. How do you feel about that? This would have been down 14%, yet it compounded out at 7 over the last 10 years. This was only down 9, and it compounded out at 6. Again, matching required return with the risk tolerance that we have. Third key decision is active versus passive. Active managers, and this can be in the form of a number of different vehicles, tends to try to beat the market. They tend to do it with their stock picking or market timing prowess. Passive managers or indexers tend to deliver market-like return. They're trying not to beat the market or time the market. And the reason is active managers have a hard time beating the market consistently. They have higher cost, have higher expenses. They generally have higher turnover, so the transitional costs tend to be higher. And they generally yield greater tax exposure. As a result, active managers fail significantly in terms of beating their benchmark returns. In the mid-cap space, 77% of active managers underperform their benchmark. In the international space and emerging market space, well in excess or near 90%. Reasons for the underperformance, or reasons that passive indexing performs generally better performance, is it eliminates cash drag. Money's fully invested. There's more consistently. You can control the diversification decision. There's less style drift of a manager trying to cheat by overweighting or underweighting and then get caught with exposure in the wrong place. And cost matter. Controlling fees often can improve investors' net return. Using an advisor who charges the same fee, recommending active management strategy versus passive management strategy can often reduce the total net fee that the investor is charged by nearly a full percentage point. That full percentage point over a period of time can add up significantly. The fourth key decision is, do you rebalance? And rebalancing just simply allows you to maintain your chosen level of risk. If we started with a portfolio that was supposed to be half stock and half bonds, and if the stock market was very, very strong, at some point we would have significantly more in stocks, as in this case 62 versus 38%. That portfolio now may be a bit too risky, and if the market were to drop, we'd have way too much stock exposure. Conversely, if bonds are strong, we might find out that our portfolio now is way too heavily weighted toward bonds. So rebalancing allows us to equalize the portfolio to the original allocation. It's difficult to do. Most investors do it improperly. It's counterintuitive. It requires you selling winners and buying losers. Most people's idea of rebalancing is, this isn't working, this is, let's sell the thing that isn't working and buy more of the thing that is. And that works till the thing that isn't, and then we're dealing with serious loss. Rebalancing can be accomplished by adding new money, withdrawing money from overweighted areas, or selling overweighted areas, as in distributions. It can help improve return and potentially reduce risk. When we rebalance at my firm, we rebalance effectively twice a year, not mid-year and year-end, but rather mid-April and mid-October. And the reason is there seems to be a bit of market seasonality. The markets tend to pause during the spring and early summer. They tend to bottom out sometimes summer and fall and then regain momentum going into the end of the year. It doesn't always work this way, but it works this way enough to notice. As an example, if we looked at 2012, markets were up in excess of 13% without dividend. If we look at the period from May 1st through October 31st, defined as the worst period for the market, we were up 1%. If we look at January through April and November and December, we were up a total of 12.2. In fact, going back to 1950, if you started with $10,000 invested, that $10,000 would have grown through 2012 if all you did was invest in the worst 6 months, then took the money out and reinvested again May 1st of the worst 6 months. $10,000 would have grown, or I should say lose, to $9,000 and some change. Conversely, if we invested in January through April and November and December, $10,000 would have grown to $706,000 over that same period of time. We rebalance then going into the best and going into the worst potential periods for the market. Benchmarking. How do I judge performance? Big decision. And it's important because it should drive portfolio adjustments and changes. What's an appropriate benchmark? For most people, they look at their portfolio and they look at the market and they judge performance based on whether we're beating the market or not. It's very difficult to do that. You can't very well judge or measure a diversified portfolio of many different asset categories to a single benchmark. The benchmark we use, simply put, is are we making progress toward your goals and objectives? And if adjustments to the portfolio can improve upon that, that makes good sense. Decision 6, do it yourself. Do it yourself often means go it alone. It's difficult, it's time consuming, and it's emotionally taxing. And as we said before, most investors are their own worst enemy. We feel more comfortable today investing after the market's already run up. In fact, last year, as an example, the market ran up over 10% from January through April. If we invested in April, we would have had a 0% return or worse until about November or so of the year before things turned positive. Timing has a lot to do with returns. And if we invest and we're prone to this emotional roller coaster, the numbers just haven't panned out very well. In fact, as we can see, the market's had a broad recovery from its lows in 2009. Yet, every single year, including 2012, we've had net equity liquidations. In terms of mutual funds, there have been net more money leaving mutual funds that are stock related going into bond funds. There have been net positive purchases in bonds and net positive redemptions in stock. People are selling stock as the market's going higher. And because of that kind of logic, the average investor has fared poorly comparing their returns to the actual returns of the broad-based market. If we look at mutual fund investors and compare the return of the S&P over that 10-year period compared to the average stock fund investor, the S&P averaged 8%, where the average stock fund investor averaged just 3.17. The average bond investor would have enjoyed 1% when the Barclays U.S. Aggregate Bond Index enjoyed 7. The reason? For one, buying high, selling low, getting out at the bottom instead of buying at the bottom, and buying in at the top instead of trimming back or rebalancing. And second, chasing hot funds. Remember the dot-com bubble when everybody couldn't get enough technology until nobody wanted any technology. Investors may have difficulty with proper allocation, proper diversity, rebalancing. Multiple accounts probably means multiple fees and not maximizing the potential fee reduction. You might not have proper rebalancing and proper diversity with overlapping assets. In my opinion, there are three qualities needed to effectively do it yourself. You need knowledge of markets and economies. You need the time to review, research, and revise. And you need the desire. Is this something you seriously want to spend time on? If we lack any one of those, the best advice is to delegate. So let's wrap up. Retirement planning, it's not easy. Investing, it's not easy. Success is often driven by a clearly diversified process, something that most folks simply don't have. Fees are a big detriment. Fees are important and they add up over time, so it's important to be efficient. Do it yourself means go it alone. A qualified advisor can help bring some discipline and clarity. With a good advisor, you can control cost, properly diversify, establish an appropriate asset allocation, monitor and rebalance, and can maintain the discipline to stay the course, walk you off the ledge, so to speak. And that can be worth thousands upon thousands of dollars. Picking an advisor is confusing. Let's face it, we all kind of look the same. Even the term financial advisor, as opposed to certified financial planner or other designations, very, very confusing. Anybody can use the term financial advisor. Some are doing investment planning differently than others. Some can be better than others. If you're interviewing, ask these key questions. What do you do? Who do you do it for? How do you do it? And what makes you different? With my firm, that's easy. What do? We provide financial education for clients and groups. Provide financial planning, investment management, and asset protection. How do we do it? We do it through a very scripted, detailed process. All of our clients run through the same process so that we know exactly what goals and objectives are. They know exactly what our capacity and capabilities are. We do regular follow-up meetings and reviews, whether here or via teleconferencing or webinars. We can bring in teams to help as well. Who do we do it for? I mentioned that the bulk of my practice are engineers and automotive folk, but in a word, we do it for delegators, folks that lack the knowledge or time or interest. Qualities that make us different. We tell our clients we're local, liquid, and transparent. By local, I'm referring to the fact that our solutions are created here. No third party, no black box solutions. I'm not selling some fund managed from some outside agency somewhere else. If you have a question about anything in the portfolio, we can tell you why it's in there, why we put it in there, and what we were thinking. Liquid. Every strategy we have has a strong focus on liquidity. No surrender charge penalties charged by our branch. You can get out of anything instantaneously. Funds, other types of vehicles can be liquidated either real time or at end of day. No penalties, as would be the case with other types or surrender charges with other types of securities. And transparent, meaning clear understanding of all fees. You see exactly what the fees are. They're detailed out. No soft dollar fees, no hidden cost. And a clear understanding of portfolio makeup and transactions. How do we do that? We host a number of webinars, as well as regular meetings. Every quarter, we do a capital market review that we invite our clients to. That gives you a really good heads up on what we think is happening in terms of the economy. We also do multi-asset globally diversified webinars and invite clients who have portfolios similar to the portfolios I spoke to you on, where we can talk about adjustments and changes to the portfolio, what's working, what's not working, what adjustments we've made since the last time we spoke, pushing a lot of information out to our existing clients. We take a team approach. We work with our team members as well as your team members to come up with a unified strategy, a unified approach to wealth management. So ask yourself, are you 100% satisfied with your advisor? How about the investment plan that they've had you follow the last several years? Was there a plan? We know investing is complex. It involves serious dollars, your life savings. So how about getting an unbiased second opinion? You know, if you were inflicted with a disease or an illness, you would seek several second opinions from several different medical practitioners. In fact, if you were doing a construction project at home, redoing the kitchen, you would seek several quotes and several opinions from several different contractors. So whether you have an advisor or you currently go it alone, why not a second opinion? Today it's prudent, it's essential, no cost, no obligation, absolutely nothing to lose. With that in mind, I'd like to thank you for attending. If you have any questions or would like to contact us for a second opinion or to talk further with me on any topic at all, simply contact us at the site KaydanWealthManagement.com. I'd like to open up for questions. If you have any questions, you can certainly text those in, and Danielle Nickerson will be able to help and assist me. Thank you, and have a wonderful evening. I certainly do appreciate the time we've spent together. Good night.